All right, good evening, everybody. My name is Doc Severson, and I'm going to be talking about the 4 powerful rules for trading any chart and any time frame. This is really the methodology that I've written about and I have used to cross the 7-figure threshold. So maybe you know who I am, maybe you don't. Again, my name is Doc Severson. I'm an individual trader and performance coach since 2005. And currently working with the 12-minute trading daily income service, as well as I've been doing Ready Set Crypto since before crypto was a thing back in 2017. You may have heard of my name through services like Options MD or Theo Trade or Doc's Trading Tools, or even the old Options Linebacker from way back when. My specialties are fractal price analysis, which means multiple time frame price analysis. We're going to get into that tonight. Options and futures strategies, and because of the fact that I had a lizard brain like everybody else, I had to focus on understanding the trading mindset and how to fix it. And because of this, I wrote a couple of books that are available on Amazon. First of all is Hacking the Holy Grail. This is how to pursue profitability, how to learn to think like a trader instead of thinking like the herd, like everybody else. And fractal energy trading, which is really going to be the topic of my presentation tonight through those 4 powerful rules. You can get a hold of me at doc@12minutetrading.com if you have any questions. But with that, what I want to do is my purpose, and this is going to be 99.99% content. I will share with you an opportunity later on, but I'm only going to spend about 30 seconds on that. So my purpose today is I want to pay this forward. I want to show you a fundamentally simple system that can be used for trading any instrument on any time frame. So if you trade futures or trade options or trade stocks or crypto, you can use the same system for anything, depending on whether you're a swing trader, a longer term investor, or even a day trader. You'll be able to anticipate moves before they happen. You'll be in a position to better understand the fundamental structure of the markets. I can look at the market now and see what's going on. I can anticipate. This is different from predicting the future. Everybody talks about predicting the future, which of course is impossible. But what I can do is I can anticipate potential moves. I'm also going to share my favorite indicator with you through the end of this session. Okay, so that's my purpose today. And I hope you learned something. If you could take one thing away from tonight's presentation, it'll be worth your time and attention for the next 60 minutes, because one of these concepts will change your life. They're that powerful. Okay, so being an engineer, what I'd like to do is I'd like to start, or I would say former engineer, now reformed engineer. I always start with a problem that needs to be solved. That's what we do. We fix problems. So what is broken? What's broken right now? What do we have to fix? Well, I would say accurate charting and price discovery leading to trading edge. Our own embedded human nature ensures that we start the wrong way. Everybody comes out of the factory completely programmed 180 degrees from what they need to be in order to make money. So let's talk about this for a second. How we all start with analysis. Unless we're lucky enough to snag a job on the street out of college, everybody starts in the same manner, lost in the crowd. We are herd animals. My favorite thing to do is to join 100,000 of my closest friends and go watch a football game on Saturdays. It is in our nature to go with the crowd. No one wants to feel like they missed out. We want to be part of something bigger than ourselves. We are herd animals, guys. So we're also used to social logic, and this is really over the past 25 years. If you want something, what's the first thing that you do? You go check the Amazon reviews. Oh, 5 stars is better than 4, which is better than 3 stars. Based on what? Some unknown anonymous person posting a review. It could be a bot even. We don't know, but we implicitly trust those. So at no time in our history has there been so much freely available information, much of which we trust. You know, so who's to say that the Bacon Bros really did earn that 4-star rating for their breakfast? So this is my point here, guys. We've outsourced or socialized our decision-making. We no longer do it ourselves. Social investing, what this means is we're part of a Discord and we're carrying our bags there with a Discord, right? Or we're part of some service or part of some group or part of some Facebook group, something like that. And if we do the same thing that we do in life, right? If you want help with something, you join a group. You want to feel like you're part of something bigger than yourself. So we get into financial markets thinking that the safest thing is to just go along with what everybody else is doing. Trading just becomes another extension of social media. Well, the problem with that is that we are then swimming with the sharks. You're always chasing the price of an asset. You feel like you're behind and you have to catch up. This is where we get into FOMO or trading based on fear. This is not going to work. This is not a good idea. So a lot of us go through this phase and we say, well, that doesn't work. So what's the next thing that we typically do? We get involved with investing media. You think that the investing media is your key to knowing what's about to happen in the markets. So we sign up for various services or we watch CNBC or Fox Business, something like that. But this is where we're also being played. This is famously the Bill Ackman during the pandemic, or the very beginning of the pandemic, scared the living daylights out of the market, basically came on and said, we need to shut down the United States for 30 days to handle this pandemic. Well, the market went immediately like that. Okay, guess who was short? Bill Ackman. Guess who covered immediately after that move? Bill Ackman. So to some degree, the guy was talking his own book. I don't have a problem with him. They asked him what his opinion was, and he came on and said it. So it was up to him to execute. But across the board, really what they're doing is they're looking for your eyeballs. They're looking for your clicks. They don't really care about helping you make money. So that's the investing media. It's not your friend. So we're looking for guidance, right? We know that we need help to get away from the rabble, but this search can be equally difficult to find someone that aligns with your belief system. It feels like everyone is out to take advantage of you, right? Everybody's out there taking advantage of you. You feel like you're just out there alone. So you've tried to get help with this, but nobody's helping you. So this is how we start. Okay. So what you have to do ultimately is you have to find your own way. And this is what I've seen, the very narrow path to success. Ultimately, everybody that you're going to hear for the next 3 days has found a way on their own to make things work. Now, what they've done is generally borrowed from others that have gone before them. There is nothing wrong with that, but you have to internalize your own approach. So when you do that, we know what we're trading and why. You've stopped trying to be a jack of all trades and a master of none. You finally know what you trade and why you trade it. You have a plan. Failure is not an option. You're starting to trade like a business instead of some kind of adrenaline-focused hobby. Price discovery for the pros used to be right in front of their face. And if you've ever been to the CBOE or CME or anything like that, you know what I'm talking about because it's right there. Literally that 1 square foot of space that you're spending time on is where your price discovery. So it's not only the sounds and the sights, but to some degree, the smells of price discovery as well too. But unfortunately, none of us have that advantage anymore. So today's challenge is just you and the chart and your monitor. That's it. That's the challenge with price discovery. So everybody that's gone upstairs from the floor is going through the same thing. So this is where we run into problems because many of you are probably doing this right now. Is more better? You're going to hear about a lot of indicators in the next 3 days. Do you need all of them? So at the very beginning, when people find out about technical analysis, there's very much this sort of push that more is better. So we're going to start with price in our chart. And we're going to say, well, this doesn't tell me anything. So I want more than just price. let's add some moving averages so we can understand what the trend is. Now, don't forget, these are trailing signals, but it's just an average of the previous X number of candles. But there you go, there's a signal. But maybe that's not enough to give you any kind of trading signals. So of course, everybody knows that you need to add the MACD, which is the moving average convergence divergence, and understand what's considered to be momentum. But you know what? These are only based on moving averages anyway. So they don't necessarily give you a very quick signal. It is lagging. So guess what? We need a stochastic to tell us when to buy and sell, when something is oversold or overbought. Well, maybe that's not enough either. And so what we're looking for is, of course, the RSI, the Relative Strength Index from Wells Wilder. And so we can now definitively say when something's overbought or oversold. But maybe that's still trailing. So we're going to add the Bollinger Bands to understand volatility for this. So volatility from a moving average in terms of standard deviations. And maybe we're going to add the Keltner channels as well too, so we can understand when something is squeezing or losing that momentum. And maybe we like the Arun oscillator because it just looks cool. And you're starting to see what most people's charts look like is the ADX for train strength. Now, what have we done through this? By adding all of these studies down here, what have we done? We've collapsed the only thing that matters. We've made everything so narrow that you could barely see anything that's happening in the price. And that's one of my messages today, is that the price has got just about everything that you need. Okay, so is there a simpler way? You've twisted yourself into a pretzel with indecision. You don't know what to do. You'll end up trading not to lose instead of trading to win. If you're waiting for everything to line up perfectly, chances are you're going to be too late to the signal. Can we simplify this? Why can't we just use price? It is never lagging. It's not based on a derivative study written 50 years ago by some dude that you probably never heard of. Look up the history on the MACD sometime if you want to hear a name you've never heard of. Indicators lie all the time because of the lag. Price never lies. It is up to the date this very second. Price is the ultimate arbiter of value. It is never wrong. If you talk to 100 professionals, chances are that a good 95% of them will be using a price-based analysis system. The longer that they do this business, the simpler and the more crude their systems are. And I'm one of those as well too. Price reflects everything that is currently discounted into the asset this very second. There's no lag. But some people come back to me and say, it's hard. Isn't this difficult? I used to have the same objections, but a little bit of time and you'll see how simple it is. Let's get started. Okay, so that's what's broken. And that's what's going to lead me to rule number 1. Remember, what I'm going to go over tonight is the 4 powerful rules. I want you to learn at least one of these. Each one of these will change your life in a positive way. If you can learn more than one, that's great. It'll happen faster for you. If you can learn all 4, then look out. Rule number 1, larger time frames dominate the trend. All right, what does that mean? Let's talk about time frames for a second. I see a lot of traders arbitrarily selecting time frames to follow. Well, this is on the weekly chart, or this is the 4-hour chart, or this is the 1-minute chart. So a lot of times people arbitrarily just pick time frames, right? So there's actually a methodology behind how we do this. So the context is important. Somebody following a very small time frame chart is going to get whipped back and forth if they don't understand the tide that the smaller time frames are following. So in other words, what I hear a lot of times is somebody following a 1-minute chart is like, hey, it's an uptrend. Oh, it's a downtrend. Hey, it's an uptrend. It's a downtrend now. And they're getting whipsawed back and forth because they don't understand the context of what's actually happening at a larger time frame, something like a weekly or even a monthly chart. The larger time frame charts are much more powerful than these intraday candles that we get whipped around. So here's an example that I love to draw because I want you to understand this. Let's say you're walking your dog from point A to point B. Who sets the beginning and ending points of your walk? Well, you do, or you should. You're 10 times the mass of the dog, even though the dog can orbit you and will frequently do that. Okay, so what happens is you guys start out in the walk, and all of a sudden the dog says, "Oh, what's this over here? This is an amazing smell over here." And okay, over here, I haven't marked this territory yet, so I'm going to go do that right now. And oh, here's another amazing smell. And oh, what's this over here? There's a squirrel. And so what's going to happen is the dog is going to just basically orbit you all over the place. But guess what? You arrive at the same destination at exactly the same time. So my point here is that while all of this stuff is happening at a smaller mass is just orbiting you, you're continuing to plod forward. You go from point A to point B. This is what's happening on a larger time frame versus a smaller time frame. So we all get caught up in this noise of smaller time frames, and we lose track of the context. And this is why we call this larger time frames dominate the trend. So here's a weekly anchor chart, and you can see the trend here going from range expansion to range contraction. But if all we look at is just this area in an hourly chart, all we're going to see is uptrends and downtrends and uptrends and downtrends, right? Well, we're going to lose the context of this massively powerful weekly trend to the upside. So this is what we call anchor chart. This is our anchor chart, the larger time frames, and we're going to take signals off of the smaller time frame chart. So think about this anchor and signal. So we'll use this terminology throughout tonight. Okay, so let's apply rule number 1. Understand what larger time frames to add to your signal chart to create an anchor chart. So it could be a daily chart, could be a weekly chart, could even be a monthly chart. Understand how to read the trend and swing direction of your anchor chart. Remember, an uptrend is a series of higher highs, higher lows, higher highs, higher lows, all the way along. And downtrend is a series of lower highs and lower lows. Being able to understand that what the trend is very important. So we want to trade in the direction of the anchor chart swing. What does that mean? Well, if we have an overall uptrend, we're going to see these swings up and down. So what I want to do is I want to trade in the direction of the anchor chart swing. Trade in the direction of the anchor chart swing, like this. And then we will use the signal chart to enter. Again, rule number 1, larger time frames dominate the overall trend. Think of the dog walking example, and you'll understand rule number 1. There you go, rule number 1. Okay, now we're going to go to rule number 2, and this is something completely different. This is talking about reversals. Reversals start from the inside out, and they propagate higher. Let me explain what that means. So reversals are the holy grail of trading. Everybody wants to find these reversals. All the bears have been looking for the last 3 months for this downside reversal. It's not happening. They keep getting run over. But this is where you get your best reward to risk, your best entries, and their best potential for movement is being able to spot those reversals. Right? So whether it's to the downside or to the upside again. So spotting those reversals are very powerful. This is the holy grail of trading. This is what we're always after. Now, using just an anchor chart is you're going to be too late because there's no real change in polarity all the way along here. It moves so quickly that the anchor chart is just too slow and too lumbering. You're not going to be able to see the reversal. So this is where we get into the concept of change happening from the inside out. things change from smaller to larger or from the inside out. Think about how a virus infects a single host cell and then begins to multiply, and then that infects another host cell. And eventually you're going to swamp your immune system. And it all started with one little virus hitting one cell. So this is a trend reversal, starts from the smallest time frames and progressively propagates to larger time frames, right? An avalanche will start from just a single snowflake at the top of a mountain, and then it collides with another one, and then another one, and then it starts a chain reaction. If you drive your car every single day, you get in, do the same thing every day, you probably won't notice simple things like your brakes becoming a little spongier, or maybe a little bit of problem with your tires or power steering. Change is often small and imperceptible if your focus is broad. Somebody else will get in your car and start driving it and say, what are you doing? This thing is, you got to maintain this. So change happens at small levels or an early warning to possible failure or reversal. Or in our case, we care about trend reversals. So this is where we get into the signal chart. Remember, we talked about the signal chart and the anchor chart. The anchor chart's not very useful for reversals, but the signal chart, if we're looking at this saying, okay, here we go, higher highs and higher lows, higher highs and higher lows, and all of a sudden now we're printing a lower low, a lower high. We now have a reversal. This is our early warning that we're reversing from the top. Just like here, this is a downtrend, lower highs, lower lows coming along. And then all of a sudden, boom, we hit a new high, higher low, higher high. We have a reversal right there. This is our early warning using the signal chart. So change propagates higher, something that starts with like a daily reversal, which you can't even see in the weekly chart, then ultimately reverses and propagates into a larger time frame. So how do we apply rule number 2? Understand what smaller time frames to use for your signal chart to help spot changes and trend faster. I typically separate time frames by a factor of 5. So a monthly chart has got basically 5 times more information than a weekly chart. A weekly chart's got roughly 5 times more information than a daily chart. And then from there, we can even go into a 78-minute chart, which is about 5 times faster than a daily chart. So think about this. Trade in the direction of the anchor chart swing. That's rule number 1. But reversals come from the inside out. They come from smaller time frames, and then they start to propagate to larger time frames. So that's rule number 2. Reversals start from the inside out, and they propagate higher. Now I got a simple one for you. So we've gone through 2 rules. Rule number 1 is larger time frames dominate the trend. And then the opposite to that, which is reversals start from the smallest time frames. Now we're going to do a really simple one. Rule number 3, descending patterns break to the upside and vice versa. Now you might say, oh, come on. But seriously, this one is so simple that everybody misses this. A descending pattern has to eventually break to the upside. Unless it's going to go to 0, it eventually will break to the upside and will start to move in the opposite direction. So again, we tie this in with reversals and rule number 2. So what goes up must come down and vice versa. Now, it doesn't seem like that. It doesn't seem like in today's market that we'll ever see another pullback or another reversal. I will guarantee that we will. It may not happen when you're watching, but we will see a reversal from this. What goes up must come down. Now, how far down it goes is really a factor of the trend. We're not talking about a permanent rise or fall because price moves in waves. This is just simple physics, guys. We're just doing simple things here. So one of the things that we can do is go to that signal chart and put a trend line there. And so that trend line is going to mark all of the important highs, the lower highs, all the way along here. And then all of a sudden, when it changes, And you'll notice that this is the first thing. So typically these are not great signals per se, but it becomes part of your filter. If you see that the trend has changed, that trend line is broken, then look for the next pullback, which ends up being the higher low. That's your signal that you're looking for that reversal. So applying rule number 3. This works on every time frame, but obviously you'll see more instances of this on a smaller time frame like intraday charts. It certainly is open to interpretation. This is very subjective. I will use these on tick charts intraday. I find that tick charts actually work much better for drawing these types of patterns than time-based charts. So it's certainly open to interpretation. Eventually, there's going to be a no doubt or break. The cycle will continue. This is used more of as a filter than a signal. It adds confluence. Look, we're looking to stack up evidence. Like we're looking to stack up these data points to say, okay, we've got 4 data points that all correlate to the same thing. Let's go for it. We have a high probability of reversal here. Ascending patterns break to the downside. Descending patterns break to the upside over and over and over again in perpetuity. It's a simple rule, but actually, if you use it properly, it can save you some hassle. And now we get to rule number 4. This is a really interesting one. Range expansion leads to range contraction, vice versa. Everything that I talk about is a natural law. Larger time frames dominate the trend. That is the natural law. When you're walking your dog, you're going to dominate the trend of that dog. Rule number 2, reversals happen from the inside out. That is natural law. Look at physics. Look at medicine and how viruses replicate and things change over time. It happens from small changes. Rule number 3, descending patterns break to the upside. Again, this is physics. Now, range expansion and range contraction, same thing. This isn't your father's market anymore. If you've ever learned about overbought and oversold, I would say that probably that stuff used to work maybe 20 years ago. But in today's world of no lack of money printing, I think this notion is outdated and obsolete. Right? So markets can remain irrational longer than you can remain solvent. So you've heard that before, I'm sure. And this is where I see the bears get completely baked again and again, where something's, it's overbought, this can't keep going higher, and it keeps going higher. It's overbought, it's got to reverse. And they get run over again. It's overbought, it's got to reverse. It doesn't have to do anything. It can do whatever it wants to. You've got to release the market to be whatever it wants to be, because it frequently does. In fact, if goes back to the social investing that I talked about before, but one of our big problems is when everybody sees and hears and agrees with the same thing, typically they're going to be wrong. So markets move differently now. They run as far as they can possibly go until exhaustion, and then maybe they go a little bit further than that. Then they consolidate and then repeat. Range expansion goes to exhaustion, and then the price moves to range contraction or consolidation. Range contraction, so when I talk about range expansion, so here's range expansion, here's range contraction. Expansion and contraction. Cycle repeats forever. It's not overbought or oversold. I want you to think differently about how markets operate. It's time for an analogy here. So think about this. If we're climbing Mount Everest, how do we do this? Does a team climb? It's only what, six miles to the top? That's not that big of a hike, right? 6 miles, that's nothing. You can do that in a day. So if you just looked at that and you'd say, well, we'll just sprint up the side, right? It's not going to happen. You're going to go as far as you possibly can, and you're going to realize, oh, 6,100 meters is a little bit higher than I thought it was going to be. I can't breathe. So you're going to go as far as you can, and you're probably going to camp out at, you're going to, absolutely feel sick, and you're going to be probably up at camp 1. for several days until you acclimate to lower levels of air. Okay, and so finally, when you get ready again, after consolidating, you're going to go as far as you can, maybe up to camp 2. Sometimes we see people go up to camp 2, go back down to camp 1. So this whole notion of range expansion, range contraction, range expansion, contraction, expansion and contraction. That's how nature works. That's how everything works in life. We go from periods of activity to periods of inactivity. And this is how markets operate as well too, guys. So if we look at this on charts, we can see this. Now, this is my favorite study. This is the choppiness index. So I told you I was going to get to this. Choppiness index, which is available through, and I'll tell you how to get this in a few minutes here. You can think of this almost as like a fuel gauge, where high level means high levels or no trend. This is all non-linear price action. This creates high levels of energy. A linear trend takes away energy. So you can think of this as the empty in a fuel tank. And then there's contraction, builds up energy again, and then all of a sudden, boom, it's off and running again. It's back down to fuel or empty, back down to empty here. So it's got to consolidate for a number of days before it can break out again, consolidation. So markets just move from range expansion to range contraction. And I find the choppiness index, if there's one study that I'm going to use besides price is not really a study, but it's going to be the chop index. This is what I use on a daily basis. So you can also see this on tick charts intraday. You can see the same thing. Range expansion goes into exhaustion. We're looking at the yellow study at this point here. And then it builds up through nonlinear price movement to full energy, and then it unfurls. It lets it go into exhaustion and then range contraction again. So when I do this, I box in. This is almost like a Darvas box. Boxing in the price action during consolidation lets me know which way it's going to go, because the price can go either direction from there. There's no law that says it must continue in the trend. This could be a counter trend move. Box in the price action and the consolidation, and it lets you know which way it is escaping that consolidation. All right, so how do we apply rule number 4? This is going to give us an early warning when a consolidating price chart is about to break out, as well as a converse warning when a trending price is about to stall out and rest. Let's think about this for a second. How can we use something like this? If we have a price chart which is going nowhere and walking sideways like this, what does this tell us that's about to happen? What does this tell us that is about to happen? If anybody wants to write into the chat, that would be cool. But the answer here is you're going to see some type of movement one way or the other. Chances are pretty good it's going to go in the direction of the trend, but it's not guaranteed. So what can we use to take advantage of that? Well, we can set up a long iron condor. That's one way to do it. We can also use a straddle or strangle or any type of scenario like that, depending on what's happening with the implied volatility, right? So a lot of factors come into play for success at this. But this is also typically when the market is very quiet. Usually the options are pretty cheap around this time because it's not doing anything. It's consolidating, it's waiting to go. And unfortunately, this is where the beginning retail trader says, oh, I want to sell an iron condor because it's a flat market. Well, they're just about to get ready to run over. They're about ready to get run over here. And I see this all the time. So being able to anticipate this is really the key. Being able to anticipate this is really a key. So there's a lot of different option strategies. We're not going to be talking about those, but you know, then you can start to see, you can just trade one chart and play it both ways. Okay, what about the other way? When a trending chart is getting into exhaustion, when it's going nuts like this, and I see an empty energy field. when I see a trending market getting into an empty energy field. What am I doing? I'm standing in front of that trend and right in front of that freight train. And what I will then do is I will set up a range bound like an iron condor, or it could be some type of a diagonal spread with very short time frames. So this is when I'm generally going short gamma for a trade like this, because I'm anticipating that this is more than likely, there's a very high probability that this is going to go like this. And it's going to happen precisely at the time when when the retail traders that are part of some kind of Discord are saying, hey, look at this, let's all go along on this. And all of a sudden they get chopped to pieces during that move. So I'm going to be on the other side of the herd by applying these principles. So this also works on every time frame, but the larger the time frame, the more powerful the signal. Typically, the signals that we use on the daily chart, maybe the weekly chart, and I'm not really trading these based on the monthly chart other than to give some larger time frame context. So a weekly exhaustion signals means that we might see several weeks of volatile, trendless action. Think about what you could do with something like that. A weekly charge signal might tell us to expect a major break in price. I'm going to show you those two examples here in just a second. So I use the CHOP index linearity of this current trend to determine the exhaustion and charge levels. Again, I've been doing this for probably the last 12 years, and I would say this by far is the biggest thing. Understanding these 4 rules has been the biggest reason for me being able to break through and follow the profitability path. So that's what I want for you guys as well too. Now this study, there's nothing magic about it. It was written by E.W. Dreiss. At some point you can Google it. It is not currently in Thinkorswim, but there is a Think script for it. There's also a script for TradeStation. Now, TradingView has got it. TrendSpider has got it. NinjaTrader, you can write a study for it as well, too. It's been a while since I've used NinjaTrader. But all of these have the CHOP index available in some form. So like I said, Thinkorswim and TradeStation, you have to do a custom study for that. TrendSpider and TradingView have got it natively. Okay, that's rule number 4. Range expansion leads to range contraction and vice versa. So we've gone through 4 rules so far. Remember, rule number 1, larger time frames dominate the trend. Rule number 2, reversals start from the inside out. Rule number 3 is that descending patterns break to the upside. Ascending patterns will eventually break to the downside. And then rule number 4 is more of the energy based. Range expansion will eventually go to range contraction. And then range contraction goes to range expansion again. So this is that notion where things that are trending will keep trending for a while until they hit exhaustion, and then they'll start to, and this is going to be when retail finally enters the chat is when you get those. And then when retail enters the chat, thinking that this is going to consolidate forever, this is where it starts to trend again. So doing the opposite of retail is your key. So here's a couple of current examples. I took these off of today's charts. Let's look at the S&P 500. Now, what I've got this broken up into is the monthly chart. This is Thinkorswim, by the way, weekly chart and daily chart. These are all separated by a factor of 5, right? Roughly. Let's not argue that, let's pretend that we have 5 weeks in a month. Now, let's look at this from a trend perspective, first of all. How's the trend on this? Pretty damn good. We have a quick little tariff tantrum, and that was reversed by printing a higher low, which trapped all the bears, and now we have a higher high. So we have a strong trend. Remember rule number 1, larger time frames dominate the trend. Now we go to the trend on the weekly chart. Real strong, no pullbacks. That's a problem. Eventually, we're going to see a pullback. And looking at the energy on the weekly chart shows that it is now entering exhaustion. So we might anticipate fairly soon some type of chop. And all it's going to take would be one disappointment with one of the Mag 7, and we will get our pullback and our higher low. Now, how are we doing on the trend of the daily chart? Well, I don't see a reversal yet. So reversals start from the inside out. I don't see any kind of reversal at all on the daily chart. So the trend risk is very low right now. What is the biggest risk is the weekly chart energy. So strong upside trend, low weekly energy, could see limited short-term upside move, but a pullback would really energize this chart. What would happen to create the biggest opportunity on this chart would be a weekly chart pullback. So somewhere down to maybe 6,100, 6,150 would really fire this thing up and send it into orbit for the fourth quarter. Okay, so that's the S&P 500. So for right now, we're just trading one DTE diagonals, and they're working out very, very nicely right now because the implied volatility is very low, or relatively low right now. Let's look at gold. This is the GLD. This is the ETF of gold. What can we do with this? Well, first of all, the trend is extraordinary. And by the way, this is a classic chart pattern which took several years to play out, which is a cup with handle. And we've already exceeded the measured move target on the cup with handle. But right now it's flirting with exhaustion. There is enough energy to power the next trend. And what I want to point out to you here is that this is an ascending triangle pattern with an upside target, which is equivalent to the open end of this pattern. So that's looking at maybe a move up to, like, say, 3,700 in gold. This is a very strong trend across the board here. Range expansion, range contraction. Look at the energy here. That is full. So a weekly trend is on tap right now. Now, there's a little bit of shortage of daily energy, but we don't really care about that much because that can resolve very quickly. So gold, strong upside trend, great energy potential at the weekly chart for another upside run before next extended monthly consolidation. The way I would play this is with an out of the money debit call spread, basically set up as a lottery trade. So it's a relatively cheap trade to play. Right now, the puts are not paying anything. So selling puts against this is just a loss of capital. That's a lot of capital to tie up for very little return. So play the opposite side of this, play the calls, and set up an out of the money debit spread, perhaps at the measured move target, which is close, and you can center that on approximately, say, like 370, and that would pay probably 10 to 1. Again, a low probability trade, but a terrific trade in terms of reward to risk. Okay, let's wrap things up here. Those are the current examples that I'm seeing. Again, really quickly, just to reiterate, rule number 1, larger time frames dominate the trend. Rule number 2, reversals start from the inside out at smaller time frames. And then if the reversal has got any staying power to it, it will start to propagate to larger time frames. Rule number 3, simple. Descending patterns break to the upside. Ascending patterns break to the downside. And then rule number 4 is something that we all live by every day: range expansion, range contraction. And that's even after the Thanksgiving dinner. Range expansion goes to range contraction. As that, what is that chemical, the tryptophan or whatever kicks in. All right, and we went over some examples. So let me summarize here. I'll keep you guys on time and set up Tim. Maybe even Tim could start early. Where do you go from here? So it's my belief that everybody needs to shift to price and energy-based analysis. Ditch the old paradigm that no longer works. Get rid of all those studies in your chart. Forget about overbought and oversold. They don't work anymore. So how do you get started on these steps? Well, And a really simple way is to join my full 15 module course at 12minutetrading.com/fractal energy. And I've got a coupon code for tonight, 77 bucks, which will work over the next couple of days. So if you go over to our site, if you go to courses, so this is 12minutetrading.com. You go to courses, this is the first course that's available, 12-minute trading fractal energy masterclass. So I've been teaching this class for a number of years, and we keep making it better and better, and it works for today. So if you get started today, you'll see that you can come in here and put in a coupon code. If you have a coupon code, if you type in fractal into the coupon code and apply that, you're going to get it for $77. So this will be good for the next couple of days or thereabouts. And it's a great class, if I do say myself. It's will make you think differently about how the market operates. So for once, you're going to have basically a recipe for how the markets actually move. And so you're no longer going to look at the chart and say, what on earth is going on? So this will be a big revelation to you as you apply these 4 rules. And you don't have to do them all at once. You can just start with one simple rule, like maybe rule number 1. And rule number 1 will transform your trading, because you'll see pullbacks in the direction of a main trend. And instead of panicking and flipping short, you're going to realize that the context is telling you to look for that pullback. Okay, I'm going to open it up to any questions here. I've got a couple of minutes, and then I'll throw it back to Dave. Any questions for today? Remember, go to 12minutetrading.com and just look for the courses. Look for the courses here, and it's under Fractal Energy Trading, and use the coupon code Fractal. Okay, I'm seeing if there's any questions in there. Is there a daily trading? Yes, we do. We do have a daily trading room. We do have a daily trading room, and I'm not sure if we're offering a trial right now, but you can learn an awful lot. We go through this 5 days a week for our trading room. And so I go from 9:20 in the morning to about 10 o'clock every day. So we trade the open. We're doing some longer term income trades. We also do some shorter term when the market supports it, as it does right now. So we're doing some very, very nice little diagonal trades using low notional value XSP trades. And, I work with people, I answer questions, we look at stocks. We have a really good trading room that's out there. We've been doing for a number of years now. What comes with the $77? Okay, you can read all about this here in the website. So there's a 15 module class. Join my full 15 module course. So these are video, and they're also written text. So some people prefer videos, some people like written text, some people want to download the text and read it later, those kind of things. So I give you example after example how to go through the four major rules of fractal energy trading. Okay, any other questions? Anything else I can help you guys with? Just for grins, here's an example of, see, for example, this is TradingView, and I'm looking at Bitcoin on TradingView. And the yellow line in this case is the choppiness index. And notice how nicely this plays out. We were looking at a high energy peak here. We were expecting a break one way or the other. We got that. Now, when it did break, it went into what? It went into exhaustion, and it stopped there and it consolidated. And now what are we looking at? We're looking at another high energy signal with Bitcoin on the daily chart. And the better news here is that if we go out to the weekly chart, there's still enough energy to power quite a bit more of a trend, and the monthly chart looks even better at this point. So right now, consider getting into Bitcoin or use the IBIT, which is the ETF of that. So do I teach both using the choppiness index and the fractal energy in the course? The fractal energy is what we're saying is what the choppiness index shows. If I tell people I use the choppiness index, then it doesn't really illustrate what we're actually looking for. So this is why I call it just a fractal energy study. We're measuring the amount of energy that particular time frame has potential to trend. Yep. Yep, that's it. Good question. Okay, guys. Do I have an established win rate or equivalent information on your trading? Oh, gosh, we do. We do. I don't have that available right now, but with our trades, we're running at about a 1.7 profit factor right now. So it's not about the win rate. Win rate does not matter. It's all about profit factor. Because I could show you a 95% win rate strategy that loses money. And I could also show you a 30% winning rate strategy that makes a lot of money. So really what you want to look for, what you want to ask people about is their profit factor and how effective that their strategy is. No, it's not risk reward. It's the profit factor. So for every dollar that we lose through trading, we make $1.70. That's what's important. That's what's called the profit factor. Do I teach which strikes to select for the straddles, strangles, iron condors, iron butterflies? So you pick your strikes. So those are different courses that I've got. So we've got Zero DTE Masterclass. We've also got the Campaign Cash Flow Masterclass. These are all different classes that I've done, none of which are really, these are a different scope than what I'm talking about here tonight. But you're welcome to go check those out because they're all very affordable as well too. I just don't have a coupon code for you tonight. Okay, guys. Thank you very much. And David, I appreciate the opportunity to come in and talk with your crew. Once again, it's always a pleasure.